Are you waking up and the first thing you do every morning is check your portfolio in the hopes something might have changed? Are you panicking because the investments that you have made over the past few months are down over 20%? Or are you even considering selling all your stocks just because someone on YouTube went and did something they told millions not to? Well, if that's you, then stop what you're doing right now, because in this video, I'm going to be giving you some top tips that you can start using today to hopefully take your stocks from the red to the green in the near future, including an investment strategy that will actually give you a guaranteed 25% return on your money. But before we get into that, we need to understand why we're actually here in the first place. And it all starts back in October of 2008, where the world saw the start of a financial crisis that sent both stocks and house prices tumbling by more than 10% in a single day. However, since then, things have been pretty good for investors, with the odd exception of course, but generally speaking, if you'd have invested anything in the past 10 years or so, you would have likely made some good money. Now let's bring things back to today, where we see ourselves in our 14th year without a major crash, extending the winning run to 6 years past the magic 8-year average, when most predict a crash would actually take place. And when you combine this with what's actually going on in the real world, it pretty much explains why things aren't looking too good right now. First up, we have a big inflation problem right now, with rates rising to 6.8% in 2021, which has happened from a combination of labour shortages, supply chain breakdowns, and a sudden surge in demand from people coming out of their lockdowns caused by the COVID-19 pandemic. Next up, because inflation is the main problem, the most common way in fixing this is by raising interest rates. And when interest rates go up, this gives people less motive to borrow money, which then leads to less spending, which then leads to less growth in the businesses that we all love investing into. And then finally, when you combine all of this with confusion on what the Federal Reserve is actually going to do to combat all of this, this leaves investors in a very uncertain situation, which is why we're seeing the high volatile stock market that we're seeing today. And whilst no one can put a date on when this short-term pain will actually end, history tells us that this is only going to be a small dent in comparison to the bigger picture. However, there are some things that we can start doing today to turn this from a negative experience into a slightly more positive one. And let's start with rule number 1 for those maybe feeling a little bit anxious about their investments right now, and that is, if in doubt, zoom out. Now, if you're a long-term investor like myself, you need to understand that stock crashes and stock corrections are simply just part of the game. I honestly don't think I know one investor out there that when they first started investing, they thought it was impossible to lose money. Maybe NFT holders. But anyways, if you are worried, just simply zoom out. Let's take Apple stock for example. Now, so far this year, things don't look great, right? However, if you move your mouse over to the right slightly and click on that 1-year chart, you can see gains of 11%. You move it to the 5-year chart, you can see gains of 424%. And if you were lucky enough to be investing since Apple's IPO, well, you wouldn't be watching this video because you'll be simply too rich to even care. And whilst this is just the comparison of just one stock, which also happens to be the largest stock in the world, the same can be said when looking at the broader market too. Let's take the S&P 500 for example. Once again, the year-to-date chart is looking pretty ugly, with the index being 9% down overall. But when we zoom out once again, we can really just see the small effect that this sudden decline recently actually has on the bigger picture. So if you are one of the 41% who voted on my community poll saying that they are investing into funds this year, if you stick it out for the long term, the likelihood is you're going to be just fine. Which actually leads me to my next investing tip, which is, if you're worried about the stock market, just delete your investing app. Because at the end of the day, if you're investing once a month into something like a Vanguard index fund and you have no plans to sell your stocks in the short to mid term, why do you even need to keep check on what is actually going on every day? And yes, I do get it. When you first start getting involved with investing, or maybe when the stock market is going up every day, it is very hard to not actually want to look. But in times like this, when you're not going to do anything on it anyway, it's simply just a case of the more that you look, the more unforced fear that you're just simply going to inject into your mind. So what's the point? Just delete your app, and when you do want to start investing again, just reinstall it. It's a 2-minute process. Now, if the thought of this is completely unbearable and you just can't bring yourself to doing it, well, why don't you try what I do, which is instead of keeping track of your investment portfolio balance, just keep a track of the companies that you're investing into. What I essentially have is a watch list of all the different companies that I invest into on yahoofinance.com, and all I do as part of my morning routine is have a quick flick through all of the different companies' news articles just to see if there is anything that I've missed. And doing this is actually really good, because if the stock was down on one day and there was no bad news on the company, I know that it's more so the state of the market rather than how well the business is actually doing. This then gives me more confidence to buy into the businesses that I own at a cheaper price, which actually leads me to my next tip, which is this shouldn't actually be looked at as a negative. It should be looked at as positive because you can now pick up the stocks that you love for cheaper. Because when it comes down to it, if you're a long-term investor into a company you believe in, the stock price right now shouldn't actually have too much bearing on whether you should invest into that company or not. So having said that, if there is an opportunity to buy that stock for cheaper, then go for it. And the term for this is called lowering your cost basis, or what some people call averaging down, and this is where the best investors really make their money. And honestly, I believe that anybody that invests into individual stocks should actually be considering a move like this right now. Times like these should be used as opportunities to buy more for cheaper, and if you are looking at your stocks and you're panicking and you're thinking about selling it, you really do have to question why you actually invested into that business in the first place. Now, I'm sure we've all heard countless amounts of times the famous quote from Warren Buffett that reads, "Be fearful when others are greedy, be greedy when others are fearful." But if advice from arguably the world's greatest ever investor still doesn't have you convinced and you're still maybe a little bit worried about your own portfolio, then this option could be great for you, and that is opening a government-funded lifetime ISA. So in the UK, most of us retail investors will place all of our investments into what we call a stocks and shares ISA. This is essentially a tax wrapper that allows us to invest up to £20,000 into investments, and any gains that we make or dividend incomes that we receive will be completely tax-free. However, with a lifetime ISA, you can essentially contribute up to £4,000 in cash every year, and in return, the government will actually add a 25% bonus to your savings with a maximum of £1,000 paid out every year. This means that you do not have to worry about the ups and downs of the stock market. However, just like all good things, it does come with its limitations. First off, as it is a government-funded lifetime ISA and the bonus is so attractive, there are actually only two ways where you can actually withdraw your money with the added interest. This is if you're either going to buy your first home or if you're planning on retiring over the age of 60. So if one of these two options is your goal, then maybe this is a great option to go for, especially if you do not want the stress of your stocks going up and down all the time. The only thing that you do need to consider is that if you did want to withdraw your money out early, then you will pay a 25% withdrawal charge, which is the money that the government had added on for you, plus a little bit of change from your original investment. But nonetheless, a really good stress-free option worth considering. Now for me, I've pretty much come to the conclusion that 2022 is going to be a rocky year for the stock market, and it's one that I've been expecting for 4 years ever since I made my first investment. I knew when I first started investing, I was investing right in the middle of a bull run and things couldn't possibly be better. I knew all the information that I was taking in from people on YouTube were from people that had never experienced a market downturn, and I knew that if I did want to become a successful investor in the future, then it's times like these that I would have to navigate successfully, and this is why I'm sticking with my exact same plan that I had from day one, and that is simply to continue investing into the companies that I believe in long term, dollar cost average into my ETFs and index funds, and focus on growing my income over time so that I can invest more money into the market, essentially making me more money in the future. Now, if you're looking to do the same, then I really recommend going and checking out this video, which is going to teach you how to do just that. But having said that, keep investing, guys, keep your head up, and we'll get through this.